This month there's been some extreme volatility in the market. So what has it done for my portfolio? Amazon's fundamentals are looking increasingly strong. Strategy is starting to recover and has shifted from a pure Bitcoin leverage play to a buy and sell Bitcoin strategy. And Tesla has shown some real weakness lately, despite the overall market sitting at all-time highs. So today we're going to look at the bear case for Tesla, and given how it's the only part of my portfolio that has stopped growing, should I sell? We're going to address the FUD regarding strategy and how MSCI could exclude them from their indexes. And finally, we're going to touch upon Amazon's earnings call. But first, let's check in with Tesla. So as we check in with the portfolio, everything is lagging the market. Amazon is lagging only slightly. Strategy is just in the green, but Tesla is still 4% down, lagging the market by nearly 10%. So a lot of investors are asking themselves, is the time right to sell Tesla and just roll that money into the market index fund? Well, you can see over the last year, it's underperformed the market, and over the last 3 months, it's down nearly 20%. That is a huge loss over 3 months. So let's check out the bear case for Tesla and come to a conclusion for ourselves. Firstly, even after this drop, the PE ratio is sitting at 296. For comparison, Amazon's is sitting at just above 20. That is nearly 15 times the amount investors are paying for each dollar of profit. Now, many investors are asking themselves, why pay such a premium for future businesses such as robotaxis and autonomous robots, which are not a certainty? Now, this links in with Elon Musk over-promising and under-delivering, and sometimes just taking a long time to deliver. I always think back to the Cybertruck and how it was always promised for next year for multiple years in a row, until it eventually came out. Now, because of this, a lot of investors are wondering if some of these businesses could potentially simply fade out and not happen. Now, they've actually discontinued production of the models S and X to focus on Optimus production. And investors may think that they are making a mistake, as this is an expensive transition to go through. And it could take a long time to bear fruit. There was good demand for these cars which produce revenue, and it's now been swapped out for something that is not yet producing any meaningful revenue. Now, of course, Optimus could work, but it is not guaranteed, and that is making investors very nervous. And it kind of rhymes with when Facebook changed their name to Meta and decided to focus on the metaverse, which just a few years later they had to walk back and refocus from the metaverse back to their core business. And I wouldn't be surprised if they change their name in the future as well. Now, this is completely different. I think we can all agree that autonomous robots and self-driving cars are much more of a likely reality than people spending days and weeks at a time in the metaverse like we all live in Ready Player One. But some investors, I'm sure, are seeing similarities between these two decisions. So there's many reasons that investors are getting nervous, but I think these are the main ones, and I don't want to spend the entire video focused on one of my positions when there are 4 in the portfolio. So why, after saying all of this, am I still holding on to a losing position in Tesla? Well, firstly, this is a young portfolio from a young person. Quite frankly, I have the time and the recurring income to take risky positions in my portfolio and still recover. But there is still some great growth happening over at Tesla. The car business is actually doing really well. They had a record number of deliveries in Q2. And there are multiple bets Tesla are making that if even one of them pays off, it's going to be absolutely huge and a massive game changer. Now, we all know that AI is already playing a huge role in our economy. And Optimus could be used in factory lines, warehouse staffing, and a version could even be used in other situations like fast food restaurants. This is probably going to happen if Tesla does it or not, and that would revolutionize operations for companies globally. And then we get onto robotaxis. Now, Tesla already has robotaxis operational in Miami, Orlando, and Tampa. So you could take one from Universal to Disney, for example. A fully self-driving robot taxi is something from the future, but it's happening right now. And the plan is to obviously expand outside of those areas in the future. So no, I won't be selling my Tesla shares. Now, this is just a 10% allocation in my portfolio. And if it falls every time my monthly payment goes in, I get to buy this company cheaper. At £1,000, this position was worth £100. So when the portfolio inevitably reaches 10,000, it will be worth 1,000. Even if it goes to zero after that, I am not worried that I'll be able to make £1,000 back before I retire. So I'm not exactly stressing about this position being a bit of a risky one, which is why I'm quite excited when the stock goes down, because I buy more of it cheaper and I get to participate in the future growth of this quite exciting company. Now, let's move on to strategy. Now, don't forget, if you are wanting to get started with investing, please use the link in the description to sign up to Trading 212. It really helps me and the channel grow. And it also gives you and me a free fractional share, which could be worth up to £100. So let's move on to strategy. So since my last portfolio video, a lot, and I mean a lot, has happened with strategy. And unfortunately, the market has been very mixed, but mainly leading quite negative on strategy, and there have been some extremely strong opinions. So really, there are three elephants in the room. They sold Bitcoin. STRC, their preferred and main product, lost its $100 par and dropped to $71 in June and still has not recovered fully. And finally, more recently, MSCI, a company who provides indexes, has proposed for the second time this year to remove strategy and similar companies from their indexes. Now, for anyone who doesn't know, MSCI has decided to propose new-ish rules to distinguish regular operating companies from investment funds or trading vehicles. Now, this actually, believe it or not, only affects three companies. There's a company called Yellowcake, which is based in the UK, which holds uranium reserves, and then there's two Bitcoin treasury companies, those being Metaplanet and Strategy. So out of the entirety of their 293,000 companies, they have created new rules seemingly out of nowhere, and it just affects three companies, two of which are digital asset treasuries. Now, quite frankly, this seems targeted and simply means that someone or everyone over at MSCI simply do not like Bitcoin or Bitcoin treasury companies, and it feels very unfair and very targeted. Now, Michael Saylor has obviously pushed back on this, and Fong Li and everyone over at Strategy don't seem to think this is very fair, and I agree with them, quite frankly. Now, during these portfolio videos, I won't give too many strong opinions, but I do think that this is targeted, and I think it is extremely wrong. Now, I actually don't think that they will get away with it in the long term, and even if they do manage to remove these three companies from their indexes, I think they may have to add them back in eventually, but I am just speculating, of course. But how serious is this? Could it be the end for Strategy? Well, not exactly. So in a recent investor Q&A, Michael Saylor said that the overall flows from MSCI accounted for between 4 and 5% of the overall flows into Strategy. Now, this means that while it's significant, if the worst were to happen, it wouldn't have the catastrophic effect that many people assume. So let's talk about Stretch, their preferred. It traded down $71 a couple of months ago and is slowly but surely increasing itself back to the $100 par. Now, in fact, by the time you watch this video, it could have already happened. Now, Strategy has shown that they're more than willing to do more or less anything to get Stretch back to par. And the whole reason for Stretch falling in the first place was unclear, but seemed to have something to do with an initial drop and then potential liquidations happening from there. Now, there's many triggers, but one of the triggers that people point to mainly is Strategy selling just 32 Bitcoin to essentially show the markets that they are willing to sell Bitcoin in order to strengthen their product and pay their dividends. Now, I just mentioned MSCI, but I think it's clear that Strategy are aiming to be included in the S&P 500. Now, the S&P is a much bigger pond for them to swim in, and if they are not willing to sell Bitcoin, then they are essentially holding an extremely valuable asset with no use to it. So it would be valued by the Standard & Poor at $0, despite being worth tens of billions. Unfortunately, the market reacted badly to this, or at least seemed to. Stretch lost its power in a big way, and it also brought down the price of competitors like SATA and Metaplanet, as well as potentially inducing a sell-off in Bitcoin and the crypto market in general. Now, personally, I don't believe that 32 Bitcoins being sold did all of that on its own, but that is the narrative that was being pushed at the time. But since then, Strategy has come back in a big way. They hold over $5 billion in cash, enough to pay nearly 4 years of dividends through Stretch, and quite frankly, it has never looked stronger. They've also sold a few thousand more Bitcoin than that 32 since June, and the market has just shrugged it off. In fact, Bitcoin has made a big recovery since then. Now, all the while, I've been able to buy strategy at a discount, and this is the lesson I want to be very clear on today. When I believe in a company like Strategy or Amazon or Tesla, I will be buying at the highs, the lows, and everything in between. I really do believe in ABB. Always be buying. Now I want to end each year with more shares and more ownership of these companies. The price at the minute is secondary to me. So finally, let's look at Amazon. Now, Amazon has performed really well since the last video, up around about 4 to 5%. But it's still lagging the S&P by just a little bit. Now, there isn't really much to say about Amazon. Everyone knows it's a great company. It's in the Mag 7. Its earnings call exceeded analysts' expectations with $200 billion in revenue in Q2 alone, driven mainly by Amazon Web Services growth. And the company increased its CapEx guidance despite the critics saying there is too much CapEx spending. Now, they were able to do this and be quite comfortable doing so as well. So all in all, I believe that Amazon will exceed the market over the next decade or so and will continue growing, and I feel very safe in my position now. So that's all for today. Remember to subscribe, like, and ring the notification bell. And don't forget, if you are thinking about getting started with investing, Trading 212 is a great platform. Please use my link down in the description for that free fractional share. And I will see you in the next video.